Okay, what you see here, what do you see here? I don't know what you see here. We lost £1,000 last week, and that's the headline. But I have a story to tell you. When the coronavirus hit, the markets went a little bit mad, and it took a while to settle down, but I was feeling like I needed to start these videos in order to demonstrate this trader, because quite frankly, a lot is hinging on this trader for me. I wanted to start, but the market had only stabilized for about a week or two, and it gave me a very small amount of data in which to calibrate the algorithm to the characteristics of the market after the coronavirus gyrations. I set up the algorithm, but I was worried about its robustness, its ability to keep making profits over the long run. Now, in the short run, it made money, it made good money, but my worries were borne out, and I'm going to show you this. So, first of all, over the week, we lost about £1,000 because if you recall, the beginning balance is 13,000. That's the actual money in the account. But we had another £1,000 of trade equity, an unclosed trade that was worth about £1,000, and the algorithm lost it. And in fact, in the first 2 days, this is the first 2 days of trade last week, we lost, well, this is £700, but add to another 1,000, that's almost £2,000 it lost over 2 days. And this figure here, the 12.4, is now in the red. This entire account, our so-called money account, was in the red. And this worried me. So what I did is I had another experimental account, which I actually demonstrated to you in the first couple of videos, and then I stopped showing it. The hope was that it would begin outperforming the main algorithm, and it did. So while this was losing money, my experimental account was actually making money. And I thought, okay, I'm going to switch them. So after Tuesday, well, on Tuesday, in the middle of the day, I swapped out one algorithm for another algorithm. And the good news is, so this is the new population, it made money, exactly as I'd hoped. And the old algorithm, I left it running for a day or two afterwards. It just kept losing money. It just kept losing money. So that's the story. So overall, we're still in profit, barely. But the other algorithm had lost money almost for a full 4 weeks. And though I have demonstrated that's possible and has happened in the past, it didn't look right. I don't know how else to explain it. I was watching it, I'm going, this just doesn't look right. This is our account over the entire time it has been open. So we started at 12.5, 12.6, and right now we're sitting around 12.1 or 2. So we're okay. We're in profit. It's better than nothing. It's the same story with the euro account that we've been following. So this algorithm didn't have a lot of data with which I could tune it. And it too lost money. It lost quite a bit of money as well. So it's thoroughly in the red now. This is the full time the euro account's been open. We started at 12.3. We're now at 12, more or less even. So we're thoroughly in the red. And there's a morbid part of me that would like to see how this account goes, whether it just drives the equity down to zero. So I might leave it running, but I am at some point going to recalibrate the algorithm for the new market characteristics. But the priority remains the British pounds, what I call the money account. So I'm going to set up, I don't have an experimental account running right now, and I'm going to set up another one because that's part of this process, is to keep the algorithm calibrated to the market characteristics in the moment. It is where algorithms tend to fall down, because what happens is they make money in the beginning and then the market changes and then the algorithm can't keep up and then down it goes off a cliff. I got my economics degree in the 1980s. I started trading real money on the market in the 1990s. Now, as an economist, I had an almost religious devotion to supply and demand determining price. And accordingly, I expected to do quite well against traders who were busy looking at chart signifiers and sentiments and volumes and all these different things. Just look at the supply and the demand. Then you'll get the price. I was so confident I put in a fair amount of money that I really didn't have. At first, things were going well. I guess economics really is a worthwhile degree. But then I lost pretty much all of it. One event in particular really shook my faith in economic theory. I was in a particular commodity and I was waiting for the government report on the state of the supply to come out. Now, if supply goes up, price should go down. If supply goes down, then price should go up. You know, basic economic theory. And they reported a shortage. And the price went down. If supply and demand aren't solely responsible for price, what are the other factors? Inequality actually has a surprising impact on price. And more importantly, the mainstream models use what's called a single representative agent. So most of the theory coming out of academics and think tanks and government policy is based on models with just one consumer. And the one thing that you can never ever discover with only one consumer is inequality. So what we're going to do now is we're going to look at one of the main causes, the main systemic underlying cause of inequality in a free trade system. And it's not what you think it is, it's physics. Imagine you're in a room and there's 500 people in that room and all those people have $100, including yourself. Now, through magic, you can reach everyone equally. So you can touch everyone in the room, all 500 people. What you're going to do is take $1 and you're going to close your eyes and you're just going to randomly give it to another person. So after you give your money, you've only got $99 left. However, what's the chance someone else is going to give you $1 and you might even receive $2? So you think about that a bit and you go, well, if you repeat that over and over and over and over again, what will the eventual money distribution be? Will everyone have close to the same amount of money? Will it be wildly unequal? What do you think? Now, most economists think it'll be a bell curve, the distribution, very tightly around the $100 mark. But that's not the case. And the distribution is not only predictable, it's inevitable. And it's because of physics. Now we can duplicate this experiment using an agent-based model, and I'm just about to show it to you. Well, this model is made up of 500 different agents. Each agent is then handed $100, all 500 agents, and they randomly give one of their dollars to another agent. Right now, the Gini coefficient is 0. It's down here. And the wealth distribution, everyone has 100. So they're all piled up. All 500 agents are piled up on the 500. So we say go. Now we start running. You can see that the agents start spreading out and the Gini starts coming up a little bit. And this shows you the wealth distribution. And you can see here we have a very nice bell curve. And this is the distribution that a lot of people predict. So if we speed this up a bit, you end up with 0.05 Gini. And this, as I say, is a physical property. It was discovered in the it was discovered in the 19th century by physicists. And it applies to objects that interact much in the manner of the free market. And you might be wondering, well, that's very, very simple rules, what you've just described in the model I just showed you. If you do more complex rules, do you end up with the same thing? And this is where it gets really interesting, because the answer is yes, you do. This paper is by a couple of physicists who have taken an interest in economics. And the reason they've taken an interest in economics is because they find the current economic analysis wanting. There's actually a tremendous debate going on in economics right now in academia. There's basically mainstream economics, which is the pillar against which all these different forces are starting to strike. For example, Rethinking Economics is a group of students who feel like what they're being taught is completely useless. There is renegade, if you will, economists like Steve Keen, who have been attacking mainstream economics for 30 years now. And then there's physicists who have moved into economics out of frustration. They call themselves econophysicists. And there's also mathematicians who are saying the mathematics that economists are using is bonkers, basically. So this is an econophysicist paper, and this is this is very basic work, and my work built on this. But this is the statistical mechanics of money. And basically what he demonstrates is that money, when you're trading and buying and selling and so forth, acts much like the Boltzmann-Gibbs distribution. If you convert this into economic terms, the Boltzmann-Gibbs distribution will give you a 0.5 Gini coefficient, which is exactly what I just showed you with that very, very simple model. Now his model is simpler than mine. And then I built progressively more complex models, and they still came out to 0.5 Gini. Now, what does this mean? Does this mean if we look at the distribution of wealth, of money in the economy, it's going to be 0.5? No. Actually, it's far more extreme than that. What it means is there's a basic underlying force in the free market. Your starting point is 0.5. Now you can introduce forces to move it up or down. Generally they move up. Any kind of inefficiency in the economy tends to move the Gini to more inequality. You also have accumulation of power, which can move the Gini up. You also have tax redistribution, that sort of thing, that can move it down. But your starting point is 0.5. Now why is this important? Human beings are basically fair creatures. We want things to be fair, regardless left or right. Your view of fair might be slightly different, but generally we want fair. We want reward for effort. People with higher effort, we expect to get more reward. We have no problem with that. The system doesn't work like that. It doesn't work anything like that at all. What this shows is if you have a population of completely equal people working exactly the same time and hours with the same effort and same efficiency, you will end up with a 0.5 Gini coefficient. And what that means is that there'll be some or very few very wealthy people, and there'll be a large number of very poor people. That's a basic underlying property of the free market system. That is before any kind of personal differentiation, such as effort or time, is taken into account. And so the problem with this is you can end up with people working very hard and ending up poor, and people working hardly at all and ending up very rich, not because of reward of giving to society, but because of the system. As I said earlier, money distribution has a very great deal to do with price. And mainstream economic models simply don't have the tools to take this into account. However, complexity models do. And having established the baseline of inequality, there's a lot of other factors in inequality, but this is an underlying baseline that a lot of people don't understand exist. So inequality is almost certain to emerge in any free market. But because of that inequality, it's going to impact the prices. And that we're going to look at in more detail next week.